Asset class investing, like index investing, is a passive way to invest. And whilst they share common traits, there are also some core differences that separate the two approaches. Index and asset class investing both prioritize diversification and controlling costs while trying to capture the return of a particular market. However, whilst index tracking focuses on accurately replicating the returns of a certain index, asset class investing is focused on the most effective way to capture its return premium, irrespective of the composition of a published market index. This is generally achieved by applying a set of rules which prioritize efficiency over pure index tracking accuracy. For example, whereas an index fund is obliged to trade when companies join or leave the index in order to continue to track it accurately, which risks prices being moved against it by other market participants who know which trades it must make and when, an asset class fund can delay such transactions until such timing anomalies have passed. The core risk premia for equities are the equity market premium, the value premium, and the size premium. The risk of owning equities, perhaps better described as the uncertainty of the return outcome, which may include large losses, has delivered a higher rate of return since 1900 than owning either bonds or cash. This should not be surprising, as in order to be compensated for taking that risk, investors require a higher return than those lower risk assets provided. Value stocks are simplistically described as stocks that are cheap because of their weaker financial position, which makes their market value lower than their intrinsic accounting value or book value. At the other end of the spectrum, growth stocks are those whose market values are higher than their book values. They are often seen as being companies with glamorous futures from which investors have high expectations and thus they are willing to pay higher prices to own them. However, extensive evidence shows that the higher purchase prices lead to lower future returns. The empirical evidence also supports the existence of a small company premium, and that owning smaller companies is higher risk than owning larger companies, and therefore investors demand a higher return for accepting that risk. Therefore, by holding systematic overweightings in favour of value and smaller companies in their portfolios, investors have a higher exposure to risk, which can translate into a higher long-term return than simply holding the whole market. The extent of such overweightings and thus the extent of the risk taken has a material impact on the long-term return of a portfolio, although there is no guarantee of any additional return, and such approaches can underperform the market as a whole, even for prolonged periods. That is why it's a risk. For bonds, the core risks are maturity risk and the credit risk. The longer the period before the investor expects to have their capital returned to them, the greater the risk they run that its value will have been eroded by unanticipated inflation. Since, in most cases, both the interest payment and the face value, the amount repaid at maturity, are fixed, the returns from bonds, which are determined by the prices at which investors buy and sell them, are therefore highly affected by those investors' inflation expectations. Long-dated, that is, with more than 15 years to maturity, bonds are therefore riskier than short-dated, with a less than 5-year time horizon. However, the fixed nature of bond returns means that the extra risk of longer bonds is not particularly well compensated for by adequately higher returns, which implies that for investors using bonds as a defensive asset, concentrating on shorter maturities may be more effective as an approach. The credit risk is simply the likelihood of the bond issuer failing to meet its obligations to pay interest and/or capital on time. Unsurprisingly, the governments of developed countries tend to be more reliable at doing so than those in emerging markets, and larger and more stable companies tend to be more reliable than smaller and more vulnerable ones. While there is a compensating return premium available from riskier bond issuers, in order to persuade investors to buy them, the rate of interest offered must be higher. Investors owning bonds as a defensive asset might be wary of moving too far away from high-quality offerings, as the risk factors become more like those applicable to companies as the credit quality declines. For more information about investing, please see the Bloomsbury Guide to Investing or reach out to us directly.